The planned transition towards a multipolar monetary landscape, a world of monetary pluralism, is evolving quickly. The globalist web of institutions, including central bank networks, the IMF, the World Bank, its client governments and credit rating agencies, have determined an effective product portfolio of countries, identifying those that should grow as well as those they wish to nurture and support, alongside a select group which can be harvested. Others, meanwhile, can be left to decline. This is a distributed empire where influence transcends any sort of sovereignty. Each major economy operates as a subsidiary of an effective product line within the overall corporation. Growth, debt, and digital design are assigned according to role. This video outlines the strategic use that each country actually plays in the near future and how its monetary and financial architecture ensures that extractive dynamics and systemic continuity are maintained. Now, the Boston Consulting Group's product portfolio matrix helps us clearly decode a product pattern. Nations can be viewed as effective corporate divisions or products, whether they're question marks, stars, cash cows, or dogs, according to their market power and their growth potential. The emerging monetary architectures of the US, China, the EU, the UK, and India can then reveal the logic of their diverging digital currency strategies. India is now moving from a question mark towards star status, supported by rapid growth, demographic momentum, and developing export competitiveness in value-added areas. Thus, India is clearly seen as a scalable colony which continues to increase its physical collateral via strategic resource purchases, together with its productive capacity in areas such as renewable energy. Its public digital infrastructure model, together with the digital rupee, confirms that it has become the template for developing economies. It's a new lab really for digital capitalism with a human capital dividend. In addition, its limited currency convertibility forces savers to actually hold domestic paper at below market yields. Now, in sum, this generates internal extraction from savers to the state, while there is external extraction through low-cost labour, which can, in the digital realm, increasingly be integrated into Western value chains. China has moved from an effective star to a maturing cash cow. This expands its influence and facilitates a deliberate change of the global portfolio. It remains a necessary growth and productivity engine for much of the world, of course. It pushes its state-supported excess industrial capacity beyond its borders. In addition, it focuses upon physical collateral wealth and, of course, its productivity backbone, which is in stark contrast to many of the deindustrialized Western nations. Its continued gradualist move towards alternative settlement infrastructure is also very interesting, whether it's through the likes of Project Enbridge, which facilitates cross-border CBDC payments, or whether it's development of programmable digital currency and even stablecoins. Shows the direction that China is heading, and then of course there's the role of gold. China's external trade surpluses can then, of course, be recycled into foreign reserves and Belt and Road lending, which exports the same model abroad, and that is, of course, supportive of an overall movement towards multipolarity, and it reflects its lower external debt loads. Thus, China facilitates industrial and infrastructural extraction where value can be captured through scale and supply chain dependency rather than through simply financial leverage. Together, India, China, and other producer nations supply the real economy ballast that keeps financial claims credible. Without them, Western balance sheets would continually inflate with no physical backing in terms of output. Now, the United States remains the cash cow of the portfolio, has low growth but unrivaled market share, its product being the dollar, still the world's primary reserve and settlement asset. In the context of the rent-seeking class, high public debt is not a weakness, but it's the cow's milk. By issuing ever more treasuries, the US supplies the interest-bearing instruments that anchor global portfolios. Its debt is tolerated and even encouraged because it feeds the system's demand for safe collateral, while there's also a demand to actually access more private capital. The US relies on others to produce the goods, energy and productive returns that justify dollar issuance. If global trade were not conducted largely in dollars or its assets, it would collapse under the weight of its own debt. It increasingly intends to finance itself through its dependence. We can expect Washington to extend its dominance through stablecoins, tokenized treasuries, and the global plumbing of correspondent banking. Private innovation also helps the actual reach of the dollar here. Whether it's Circle's USDC, PayPal's dollar token, they all help to actually perform the external work of empire, exporting liquidity without adding fiscal risk to the state or the central bank. Britain at large is clearly being treated as the dog. High sovereign debt and a narrow fiscal base together with low productivity means that Britain struggles to pay its way. Instead, it earns rents by maintaining the pipes through which global finance flows. In colonial terms, London has become the services outpost, a vital trading port, but it's no longer the empire's capital, but it remains its clearinghouse. The City of London Corporation offers the niche utility, plumbing and a legal chassis that lets global capital flow with predictable rules and minimal friction. The Bank of England's emphasis on tokenized deposits and wholesale settlement innovation, tested under Project Rosalind, and the ongoing pilot which is taking place right now, reflects this role. It seems likely the city will take a leading role in the settlement of tokenized assets. Since the euro area crisis of 2008, the EU has moved from ambition to preservation. Sadly, it remains a dog. Low growth, high regulation, limited adaptability, and an increasingly concentrated banking sector. The digital euro is the institutional response, a conservative design that preserves the singleness of money against the potential fragmentation of the euro against private US stablecoins. Its aim is not expansion, but discipline and controlled decline. The ECB in this capacity acts as a colonial governor for what is actually a fractious territory, increasingly enforces fiscal rules, curbs national autonomy and sustains the symbolic unity of the euro. The region's high debt ratios and political constraints preclude large-scale stimulus. Hence, its assigned function in the meta portfolio is therefore to stabilise, to keep the legal and regulatory framework coherent while the euro area declines. Within this framework, there is a new role for the Gulf states as a cash cow, acting as an energy-backed bridge layer, turning hydrocarbon surpluses into multilateral liquidity, linking East and West. By pricing oil in dollars, but increasingly settling in multi-currency digital forms, whether it's oil-backed tokens, local currency projects, or Enbridge pilots with China and Hong Kong. The Gulf has positioned itself as a key settlement hub for energy and logistics. Petrodollar recycling turns oil profits into global investments as Gulf sovereign wealth funds use their surpluses to buy assets in Western markets to earn steady returns, while energy importers face the ups and downs of price swings. And then there's the role of gold. And of course, Dubai has long been a key importer of grey gold from Africa. New digital asset projects aim to extend the overall model with energy-backed tokens, further transforming resource wealth into lasting financial and political influence. Each country's approach to money and digital finance reflects how it handles debt, savings and reserves. Nations that borrow heavily from abroad, like the US, promote digital finance that keeps the dollar at the center of the global trade. Countries with large savings, such as China and Japan, build systems that protect their reserves and limit money flowing out. Fast-growing economies like India use digital tools to draw in investment, while service-based countries like the UK focus on financial technology and global payments. The system stays balanced only because each country depends on the other's stability, making it difficult for anyone to change course without shaking the whole structure. Now, I think the metaphor of colonies in a product portfolio illuminates a central paradox of the 2020s. The more digital and decentralized money becomes, the more centralized its governance appears. Programmable currencies, tokenized assets, and unified ledgers promise efficiency, but they also lock each region into a defined role within the world's monetary machine. China's star may rise, America's cow may age, Europe's dog may guard the rules, and India may blossom, but all remain within the same matrix of interdependence. Increasingly, the empire will be managed through code, collateral, and debt. So I think what we can see here is coordination by design, an empire of ledgers which balances global portfolios across nations. Now, I hope you found this insightful. Do consider subscribing to the channel and check out the other videos we have here. Thanks so much for joining me, and I look forward to seeing you next time. Bye-bye.